Welcome to SS2 Accounting. Today we study the cash flow statement under IAS 7. This statement shows how cash moved in and out of a business during the period. A company can be profitable yet run out of cash. The cash flow statement reveals this. There are two sections of operating activities, direct and indirect method. Today we use the direct method. The cash flow statement answers, where did the cash go? Key purposes. Profit does not equal cash, credit sales, depreciation. Shows ability to pay debts and obligations. Reveals funding of investment and growth. Required by IAS 7 for all companies. Under IAS 7, 3 sections. 1. Operating activities, cash from core business, receipts from customers, payments to suppliers, staff, tax, interest. 2. Investing activities, cash from buying/selling non-current assets and investments. 3. Financing activities, cash from equity and debt, share issues, loans received/repaid, dividends paid. The direct method lists actual cash receipts and payments. On screen. Cash from operating activities, direct method. Cash received from customers XXX. Less, cash paid to suppliers, XXX. Less, cash paid to employees, wages/salaries, XXX. Less, cash paid for operating expenses, XXX. Less, interest paid, XXX. Less, tax paid, XXX. Net cash from operating activities XXX. Cash from investing activities. Proceeds from sale of non-current assets XXX. Less, purchase of property, plant, equipment, XXX. Net cash from investing activities XXX. Cash from financing activities. Proceeds from issue of shares XXX. Proceeds from borrowings XXX. Less, repayment of loans, XXX. Less, dividends paid, XXX. Net cash from financing activities XXX. Net increase in cash and cash equivalents XXX. Cash at beginning of year XXX. Cash at end of year XXX. Computing amounts for the direct method. 1. Cash received from customers. Equals revenue plus opening debtors minus closing debtors. Or, revenue minus increase in debtors, or plus decrease in debtors. 2. Cash paid to suppliers. Equals cost of sales plus opening creditors minus closing creditors plus increase in stock minus decrease in stock. Simplified, purchases plus opening creditors minus closing creditors. Where purchases equals cost of sales plus closing stock minus opening stock. 3. Cash paid for expenses. Equals expense per P&L plus opening accrual minus closing accrual plus closing prepayment minus opening prepayment. Simplified, expense plus, accrual decreased, or expense minus, accrual increased. Worked example, Agdive Limited revenue 400,000 Nigerian Nairas, opening debtors 40,000 Nigerian Nairas, closing debtors 30,000 Nigerian Nairas. Cost of sales 250,000 Nigerian Nairas, opening creditors 25,000 Nigerian Nairas, closing creditors 20,000 Nigerian Nairas. Wages paid 60,000 Nigerian Nairas. Interest paid 10,000 Nigerian Nairas. Tax paid 20,000 Nigerian Nairas. PPE purchased 80,000 Nigerian Nairas. Shares issued 50,000 Nigerian Nairas. Dividends paid 15,000 Nigerian Nairas. Opening cash 10,000 Nigerian Nairas. Cash from customers equals 400,000 plus 40,000 minus 30,000 equals 410,000 Nigerian Nairas. Cash to suppliers. Purchases equals COGS plus closing stock minus opening stock. Stock data not given, so use COGS. Equals 250,000 plus 25,000 minus 20,000 equals 255,000 Nigerian Nairas. Cash flow statement. Operating, 410,000 minus 255,000 minus 60,000 minus 10,000 minus 20,000 equals 65,000 Nigerian Nairas. Investing, minus 80,000. Financing, 50,000 minus 15,000 equals 35,000 Nigerian nairas. Net increase equals 65,000 minus 80,000 plus 35,000 equals 20,000 Nigerian nairas. Closing cash equals 10,000 plus 20,000 equals 30,000 Nigerian nairas. Summary of cash flow statement, direct method. 3 sections: operating, investing, financing. Direct method, list actual receipts from customers and payments to suppliers, etc. Cash from customers equals revenue plus opening debtors minus closing debtors. Net cash from all 3 sections equals change in cash position. Closing cash equals opening cash plus net increase/decrease. IAS 7 encourages but does not require direct method over indirect.